stocks are flirting with record highs, leaving investors on edge over a possible correction. So how do you prepare for a market's pullback? Let's bring in David Lebovitz, global market strategist at JP Morgan Funds. And David, is there a playbook for a correction? I mean, are there certain sectors where the damage may not be as bad?
Yeah, I think you make a very important point right off the bat, is that you need a plan for when the correction inevitably happens. We're seeing one of the longest stretches on record without a 10% correction in the S&P 500. So what I would say to investors first and foremost is, maintain a balanced and diversified portfolio across a number of asset classes and be prepared and have a game plan for when that correction eventually occurs. In terms of what we like the most, I think that international diversification is particularly important. When we look at the European economy and the underlying corporate fundamentals there, they're a few years behind the US. I think that there's more room for them to grow. And furthermore, the issue in Greece seems to be relatively contained to Greece. We're not seeing the same type of contagion across financial and economic markets that we saw back in 2012. So, maintaining that diversified approach to Europe, excluding Greece. Emerging markets, I think, look a little bit susceptible for the near term. I'd probably steer clear of those. And then importantly, the best way to hedge against the correction in equity markets is to maintain a position in high quality fixed income. We're kind of neutral on duration right now, but we do think that investors need to maintain that core bond exposure, as that's the part of their portfolio that will zig when the equity part zags during the midst of a correction.
Even though rates are set to rise, of course, that could be a threat to bonds.
Absolutely. I mean, we're in a tough spot for investors right now, where stocks are no longer cheap and bonds are looking very expensive. I think the bottom line here is that you do need to maintain that exposure to fixed income. We think that the curve is going to flatten out, so we actually think that investors might be a little bit better off on the long end of the curve. Yeah. We don't expect rates there to rise quite as much as the short end when the Fed begins to normalize policy, which should help mitigate any negative price action.
All right, I want to go back to Europe. You mentioned the benefits of Europe amid central bank action. What areas within the Eurozone do you like in terms of sectors?
Right now, one of the most attractive areas in Europe is financials. If you look at the relationship between bank earnings growth and the European lending survey, there's a very strong relationship. And what we're getting from this lending survey, what we're hearing from the banks, is that credit conditions are improving, the credit cycle is picking up. That should be supportive of earnings growth for financial institutions going forward. Broadly speaking, we're favoring cyclicals over defensives. We think defensives look a little bit unattractive from a valuation standpoint. And to your point, with a very accommodative central bank, our view is that cyclicals should outperform, given very easy policy and very cheap money.
And do you like European financials more so than U.S. financials?
So I think that there's somewhat of a different story between the two. We actually like both. European financials should benefit from increased loan demand. U.S. financials should begin to benefit from higher interest rates. Interest rates in Europe aren't going anywhere for the foreseeable future, where in the U.S., it's our view that rates are going to rise before the end of this year. However, one note of caution on U.S. financials, that rate hike seems to be getting priced in. So financials in the U.S. from a valuation standpoint are no longer looking as attractive as they did a couple of months ago, again, because investors are anticipating rising rates and they understand that that's a good thing for banks.
All right, and just real quick, in terms of predicting the timing of a correction, I mean, are there any signs that you're looking at? Certainly, as you mentioned, U.S. stocks are flirting with record highs after a 6-year bull rally, leaving investors wondering just how much fuel could be left in this rally.
Well, I think for one, you need to watch what's going on with the consumer. 70% of the U.S. economy is based on consumption. So if we have that healthy underlying backdrop, that should remain supportive of equity prices. However, if the consumer begins to falter, that's definitely a sign that we may want to think about reducing some of our equity exposure. I'd also watch, the more cyclical parts of the market, the bellwethers, if you will, see how they're behaving relative to the economic data flow. If you begin to see a deterioration in the home builders and things like that, we think that's yet another sign that equities may be a little long in the tooth and getting ready for a correction.
Right, and of course we saw some weakness in that retail sales data recently for June. All right, David, we'll leave it there. David Lebovitz, the global market strategist at JP Morgan Funds. Thanks very much for joining us.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.